We begin this discussion with a quiet but vital admission. Most of us possess a working strategy sufficient for generating profit, provided it is managed with surgical precision. Every trader who has spent hundreds of hours before a monitor eventually crystallizes a certain algorithm that, theoretically, demonstrates positive mathematical expectation. However, when the market begins to breathe and exert pressure, this crystallized algorithm crumbles like sand in palms during a rising tide. This collapse occurs not because of a defect in your trading system's logic, but due to a breakdown in the internal control center we mistakenly call thinking. We must realize that a chart is merely a projection of collective psychology, not a perfectly planned mechanism. Our obsession with finding the perfect strategy is in essence a deep psychological attempt to avoid responsibility for our own impulsive actions. When a trader suffers a series of losses, they rarely question the quality of their own reaction to unpredictable price movements. Instead, we hastily begin changing entry filters, trying to find a more accurate indicator that guarantees safety. This constant modification of a working system is the primary cause of its dysfunction, as it interrupts the accumulation of quality statistics. The true effectiveness of a trading system only manifests when it is consistently applied across a wide variety of market conditions.
The error lies in a shift of focus. Instead of perfecting the stability of their own execution, the trader attempts to perfect an external, uncontrollable factor, the chart itself. The chart will always move as dictated by major players and their demand for liquidity, regardless of our personal expectations. We must stop perceiving the chart as a source of constant surprises and begin seeing it as an object for calm, impartial analysis. This transformation requires abandoning the hope for an easy victory and accepting the harsh reality of capital distribution. We often neglect the most critical element: how we perceive the signals the price gives us and what value we assign to them at a critical moment. For example, a classic level breakout that brought stable profits in test conditions can cause internal paralysis during high volatility. This happens because the level of tension on the account increases the emotional weight of every tick moving against us. It is in these moments that our internal resilience is tested, and it often turns out to be far too fragile.
The solution does not lie in changing where you place your stop loss or adding another exponential moving average to confirm a trend. It lies in cultivating an internal indifference to the immediate result of a specific operation. We must learn to evaluate the quality of an entry and exit solely based on its adherence to our original written intentions. If we executed our plan flawlessly, but the trade resulted in a loss, it is not a cause for disappointment, but merely another step in the grand cycle of distribution. Conversely, a profit obtained by violating the rules is the most dangerous trap, leading to self-destruction.
Now we come to the core of a phenomenon that costs traders the most money: the phenomenon of buying tops and selling bottoms, a classic pattern of the irrational crowd. This movement arises from an acute sense that the train is leaving without us, which intensifies during rapid price growth without visible corrections. When price rises actively, less liquidity remains from sellers willing to enter at current prices, creating a vacuum that accelerates the movement. These mass purchases occur precisely when liquidity becomes most attractive for large players, allowing them to easily offload their accumulated positions. The peak of a price movement that we see is not so much a demonstration of buyer strength as it is the result of their mass, impatient, and chaotic entry. It is a moment of total exhaustion, where the last impulsive buyer has spent their capital, and their order has been eagerly met by a professional seller. We witness the retail trader becoming the executor of the last trade before an inevitable correction.
True market movement requires time for quality position accumulation. This is the phase where price moves slowly, usually in a sideways range, collecting liquidity on both sides. The surge we see at the top is merely a short-term exhaust, marking the completion of this accumulation and the beginning of distribution. The retail player, unfortunately, usually ignores consolidation phases, considering them boring or not profitable enough for attention. They only arrive when the chart begins to display drama and evoke a sense of urgency, which is a direct psychological trigger for unwise decisions. The reverse situation occurs when selling bottoms. After a prolonged decline, the pressure of losses becomes so unbearable that traders begin to panic close positions. This mass dumping of positions, driven by fear, creates a final, often very sharp price drop, which is an ideal place for a large buyer to enter. A high volume of sell orders at any price allows institutional players to quietly and efficiently collect the desired volume without causing a sharp spike. It is at this point of maximum despair, when the world seems black, that we see the trend reversal.
Therefore, when you feel a powerful, almost irresistible impulse to hit the buy button because the price is flying up insanely, or conversely, sell because losses seem catastrophic, you must stop. These intense emotional surges are not signals for action, but loud indicators that the crowd has reached its critical mass. Your internal panic is no less accurate an indicator of a market climax than any technical oscillator you use on the chart.
This mechanism of collective psychological failure is not an invention of the modern financial market, but merely its latest iteration. To understand why we so persistently repeat the same mistakes, it is worth turning to historical experience, detailed in the work Charles Mackay, Extraordinary Popular Delusions and the Madness of Crowds. It describes in detail how, over centuries, people have demonstrated a striking tendency to irrationally follow fleeting fashions or financial manias. Although the objects of speculation have changed, from tulips and South Sea companies to modern cryptocurrencies, the human reaction remains strikingly unchanged. Mackay shows that when the value of an asset begins to be determined not by its internal utility or expected profitability, but exclusively by the greed of the crowd, an inevitable crash is approaching. We see how people, blinded by stories of instant wealth, readily abandon all prudence, rushing to invest at the highest price points. This pursuit of ephemeral price growth rather than the logic of financial flow is a classic manifestation of mass self-deception.
Why is the crowd always wrong while you remain right? Tulipomania, stock market bubbles, and Ponzi schemes. The names of the assets change, but human psychology has remained identical for centuries. Charles Mackay's book, Memoirs of Extraordinary Popular Delusions and the Madness of Crowds, is the true Bible for anyone who wants to understand the mechanisms of mass psychosis and avoid becoming a victim of the next market chaos. Learn to spot the exact moment when greed triumphs over reason and exit the game before it ends for everyone else. The link to the book is under this video. Grab your copy now and start thinking clearly.
In the context of trading, this means that when a price movement becomes a subject of general discussion on all non-professional platforms, it should serve as a signal to you. A powerful move that generates press headlines and stimulates the desire to jump in quickly already incorporates all the necessary emotional components for its conclusion. True success in the market always requires an anti-conformist approach, which demands entering a position when it seems boring or even somewhat risky to the majority. The Trium's mistake lies in projecting their own greed onto the chart and believing that this greed must last forever to support their position. We forget that markets do not move linearly and do not obey our personal financial ambitions. They constantly alternate between phases of expansion and contraction. It is necessary to abandon the thought that today's aggressive growth automatically guarantees the same growth next week or even the next hour.
The person who buys the top is essentially a victim of social proof. They see everyone around them making money and feel an internal obligation to join the party. To successfully manage capital, we must completely isolate ourselves from this external noise, as the market always offers liquidity for an exit to those guided by emotions. Ultimately, the market is a zero-sum game, where one player's success is inevitably paid for by another's mistake.
Let's consider in more detail the mechanism of price chasing that leads to buying at peaks. When we see a rapid surge, a mechanism called availability bias is instantly triggered. Our brain overestimates the probability of the movement continuing because it is the most prominent information dominating the screen. We ignore smaller, technically superior entries that occurred earlier when the price was slowly consolidating near a support level. This happens because an early, high-quality entry requires patience and the ability to see potential where there is no obvious movement. When the price has already risen by a significant amount, the trader feels they must act immediately so as not to lose the last chance. This impulse, based on the fear of missing out, or FOMO, forces them to enter a position with a larger volume than allowed, often without proper space for a stop-loss. Such an entry at high volatility automatically puts the trader in a disadvantaged position, as their protective order must be placed too close, increasing the risk of being stopped out by the slightest correction.
The chart at this moment turns into a magnet, attracting cautious funds, as every upward move only feeds the collective belief in the infinity of the trend. Professional players know that this psychological reaction is the most predictable variable in the market, and they use it as a source of exit liquidity. They do not sell on panic, they sell on euphoria, allowing the crowd to pay for their realized profits. It is important to understand that the trader who buys the top has already abandoned their original plan and is relying on pure hope that the price will continue moving without them. This hope is the most illusory indicator, as it has nothing to do with order flow or market structure. We must learn to identify moments when our internal greed begins to dictate actions and decisively halt them.
This is why the quality of a trading system should be evaluated by how effectively it protects you from these impulsive, late entries. A good system has clearly defined conditions that make trading impossible after a certain level of price expansion from the mean. We need to develop an internal cold start that allows us to ignore a hot, overloaded market. On the opposite end of the spectrum, we have the destructive phenomenon of selling bottoms, which is a direct consequence of uncontrolled psychological pain. When a position goes into a significant deficit, physical discomfort and cognitive dissonance reach their peak, and the trader seeks to stop the suffering immediately. This is not a financial decision, but a biological reaction of the organism to a threat, commanding it to flee. The trader who sells at the bottom effectively provides the perfect exit for someone planning an entry, as they offer liquidity at the most convenient moment. The dumping of the position occurs not because the chart destroyed a critical technical level, but because the individual threshold for pain tolerance is exhausted. The price on the chart may not have reached the original stop-loss level, but the internal stop-loss, triggered by emotional exhaustion, fires much earlier. This impulsive selling often occurs after a long, grueling phase where the price has been slowly and steadily declining, creating an illusion of inevitable collapse. After the trader sells, an immediate bounce often occurs, further intensifying the sense of disappointment and injustice. This is a classic pattern where the market uses the accumulated fear of the retail player as fuel for its next, opposite movement. We must train ourselves to perceive a correction or a decline not as a personal attack on our capital, but as a necessary and healthy element of market dynamics. A price pullback to a support zone is an opportunity for confirmation of our original hypothesis, not a signal for immediate capitulation. The need for an immediate closure of a losing position is proof that the initial position size was too large, causing excessive emotional pressure. The next time you feel an acute need to close a position due to pain, stop and analyze your feeling. Does this sale correspond to your approved plan, or is it merely an attempt to escape unpleasant sensations? The answer to this question is the key to capital preservation. Trading requires cold-bloodedness precisely in those moments when it seems most unattainable. The key to overcoming these self-destructive patterns lies in developing an internal calibration system that uses the intensity of our own emotions as a reverse indicator. If you feel a powerful surge of adrenaline when entering a trade, or conversely, physical nausea while holding it, this is not a sign of engagement, but a warning of an imbalance. These physiological signals are much more informative regarding the quality of your current mental state than any indicator on the screen. We must learn to use these high-intensity moments as a mandatory filter. If an entry causes euphoria, it is likely too late. If an exit causes unbearable relief, it was likely premature. A calm, well-thought-out entry always feels boring because it is merely the mechanical execution of a predefined condition, not an act of bold prediction. This is the ideal state of mind, a feeling of neutral confidence, not feverish hope. For the trader, thoughtful execution takes priority over the result. Therefore, they must place their psychological well-being above immediate profit. If you cannot sleep because of an open position, it is a clear signal that the volume was incorrectly chosen, regardless of the technical correctness of the entry itself. Position size should be such that even the maximum loss stipulated by your plan does not cause any significant emotional discomfort. True internal stability is achieved not through suppressing emotions, but by reducing their amplitude by controlling their impact on capital. When you reduce the position size to a comfortable level, you automatically reduce the emotional influence of the market, allowing you to see the chart more clearly. Only then can you clearly distinguish where the crowd's noise ends and true, structured price behavior begins.
Thus, the task is to create an operational space where your attention can be fully focused on execution rather than on experience. If you are constantly fighting your own internal demons while trading, then you are not participating in the market. You are merely fighting yourself. Successful trading is a game of expectation and quality of execution, not a competition of reaction speed or maximum stress endurance.
We should shift the focus from perfect timing to the quality of the entry environment. A good entry is not necessarily the lowest or highest point, but a place where the market structure offers the most asymmetrical ratio between potential profit and necessary protection. This means we look for zones where the boundaries of being wrong are clearly defined, and price action demonstrates a clear rejection of a key level. Trading at the top or bottom is always difficult, because at these points, the stop-loss boundary often appears blurred or the market demonstrates extreme volatility. Instead, we should focus on consolidation phases after a significant movement, when the market breathes and allows large players to redistribute liquidity. It is here, in calm waters, that one can find an entry that allows for placing a protective order behind a reliable structure.
True mastery lies in the ability to sit out aggressive movements and wait until the price returns to a zone where your initial risk will be minimal. This requires resisting the impulse to always be in the market and accepting the fact that the best trades happen rarely and require patient waiting. Instead of chasing the price, let the price come to you, to your comfort zone, where you can act according to clear, predetermined rules. The psychology of the chart indicates that after an aggressive move, a pause occurs, which is a chance for the rational player. The pause allows us to assess whether the previous volatility has been absorbed and whether there is stable support or resistance. These are the moments when the intensity of panic or euphoria subsides and the market begins to speak the language of liquidity and volume. Thus, we replace an impulsive entry with a confirmed entry, which requires the price to make a certain move that validates our hypothesis. We do not predict, we react to a confirmed market action, which sharply reduces the emotional load. This approach ensures that your entry is a function of logic, not a reaction to collective excitement. In conclusion, we must return to the main lesson. Your strategy is likely sufficient, but your interaction with it is ruined by your psychological reaction to collective illusions. Buying tops and selling bottoms are not technical errors, but direct consequences of subordinating oneself to a mass, irrational impulse. To overcome this, we must become emotionally isolated observers. As demonstrated by the history described by Charles Mackay, humanity constantly falls prey to financial manias, where immediate greed outweighs prudence, and the finale of these manias is always the same. Our task is to refuse participation in this cycle by developing internal rigidity in executing the rules we have set for ourselves. We must learn to value consistency far higher than an accidental large profit gained on a wave of general excitement. Stop looking for external reasons for your failures. They lie in your inability to maintain internal stability when the market creates maximum pressure. True success in trading is measured not by the amount of money earned on a peak day, but by how steadily you adhere to your plan over a long period. This means that even in moments of greatest temptation, you must act like a soulless automaton executing a predetermined instruction. Let your internal feelings of fear or overconfidence become red flags for you, requiring a pause and a reassessment of the situation from a neutral position.
If you feel uncomfortable, it likely means you are doing something that goes beyond your operational zone, or that your volume is too large for the given market environment. Only through this internal honesty can one achieve the quality of execution that turns a mediocre strategy into a stable source of income.
Trading is a long game of waiting, patience, and abandoning the illusion that you can control price movement. You can control only two things: your moment of entry and your moment of exit, and both must be completely subordinated to logic, not the emotions of the crowd. Find comfort in a slow, thoughtful rhythm, and the market will reward you for your psychological resilience.